G'day everyone, welcome to this weekend general update for the 25th and 26th of May. And we've just seen a very pivotal week in the week just gone. The markets had been charging ahead around the world for most of this year, and we've been really looking for a correction, and I believe that correction started during the week. I don't believe it will amount to a great deal, and what it will do is set up some fabulous trading and investing opportunities. So this is a really important week, and I'm going to go into a little bit more detail. Going to look at some more charts and just go through the whole process a little more detailed. So let's get underway and have a quick look at what has happened over the last week. First of all, an overview. The triggers for the sharp falls that we saw in the share market can really be probably pointed to fears over QE3 being wound back, and if just the suggestion that QE3 is going to be wound back brings out the sort of market action that we saw, then it's going to be a bit ugly when they actually do it. But I think that's quite a way away. The second thing was that the Chinese manufacturing purchasing managers index numbers came in slightly below what was expected and indicating a slight contraction. That in itself is not a huge issue. It's a single data point, so we need to see how that actually trends. And thirdly, there were fears about the Japanese economy as well, despite the fact that the Japanese stock market has just gone absolutely ballistic. It's up something like 85% in the last 5 or 6 months. But the real reason is really that markets had run too far, too fast, and they had to correct. Now that is pretty much all markets around the world except ours. And you'll see when I get to the charts the incredible underperformance of our market compared to other markets around the world. So the outlook for specifically Australia, consumer sentiment index fell 7%, which was a huge fall, and that was an unexpected number, and it really is a reflection on the very sad state of politics and the sad state of policy in this country, that at a time when we're supposedly the best performing economy in the world, everybody is incredibly pessimistic about the future. We've seen the long-term decline in local manufacturing continue, with Ford indicating that they will cease production in Australia in 2016, and that's a long-term decline that has been going on for some time, and it's basically because we're just not competitive anymore. And there's probably the right grounds for further rate cuts, I believe. I think we could have another 1 or 2 before the end of this year. So more rate cuts likely. Now looking at Aussie stocks, the high yielding banks and telcos that had really pushed substantially higher, they got incredibly overvalued, and so we saw a bit of a shakeout. Now there's also a bit of an impact from the currency on that as well, so we'll have a look at that in the next slide. Now the S&P index fell 18 points on the week, and it really was a case of the correction we had to have. Now it was down more than that at one stage, but that probably wasn't too bad, but I believe it is the start of a more a more concerted decline, but probably still reasonably shallow. I'm expecting the decline to be fairly begrudging, because things in America really are pretty good. The housing market is coming back very strongly. Whilst employment numbers are still a bit on the weak side, companies are still doing pretty well, and we've got this energy revolution in America that's going to increase their global competitiveness over the next decade enormously. So things in the States are pretty good. And the bull market has a long way to go. There's a lot being written about how things are all going to fall apart fairly soon, but I believe the bull market's got a long way to go in America. So I'm looking for targets in this correction down around 1600 to 1620. If that happened to break, if the correction had a bit more downside in it, then 1555 is probably the target area. Turning to Australia, in fact, we'll just go and have a look at the S&P first. before I go on with the rest of the slides. So this is the S&P 500, so we'll just have a quick pan back and get a big picture view. So you can see there the peaks in 2000, the peaks in 2007, and we've broken decisively to the upside, and you can see there's been a very clear trend channel in place since the middle of November. Now we just got too far above the mean. Look how far the price was above the 150-day moving average. So it had to come back. We've had 1, 2, 3, we've had 4 significant pushes to the upside with only tiny retracements along the way. At some point we have to get a retracement of the larger move. So we'll get a percentage retracement of the move that started in November and probably peaked out on Wednesday. Now it's possible that that's not going to happen yet. However, if it were to happen now, then we're looking at a 38.2% retracement back to 1555. So that'd bring us in somewhere in this area here. But we might be contained within this ongoing trend channel, and so I'm looking for a retracement to the bottom of the trend channel, and depending on how fast it gets there, somewhere between 1600 and 1620. So I reckon that's our target area. You can see the RSI is still very high. We still haven't unwound much of the overbought nature of the index, so I think we've still got a bit of a ways to go there. Just looking at the Russell 2000, so just give us a bit of a look at the smaller and mid-cap stocks in the US market. You can see there was a bit of a sharpish downturn on Wednesday, but then we've seen a few of those, and it certainly held up fairly well. So I think this correction in the US will be begrudging because there's just so much buying momentum at the moment, and it may well take 2 to 4 weeks to play out. Now, just in terms of comparing other overseas stock markets, this is the FTSE 100 in Great Britain. Now you can see it's almost within a whisker of its all-time highs from the year 2000, and yet supposedly their economy is having its 3rd recession in a row and supposedly faring far worse than we are. And yet here's the English market almost at its all-time highs. Exactly the same thing with the German DAX, basically also at its all-time highs. In fact, it looks like it actually did form new all-time highs. So quite a stark contrast. Now let's have a look at our market. By comparison, our market got absolutely belted during the week. Fell 197 points on the week, and a lot of that was in the banking index. This played out pretty much as expected, as I've been indicating now for a couple of weeks, with the likely fall of the Australian dollar. Overseas money would start leaving Australia because our banks had run up a lot in price. They had a lot of profit, and the yields were getting less attractive. On top of that, as the Australian dollar started to fall, the large overseas hedge funds were starting to lose on the currency exchange. So this was very much to be expected, and that's why our market fell so much during those last couple of days. The other thing is that confidence is shot in our economy, so for goodness sake, bring on the election and let's get some consumer confidence back. Let's get some effective government policy, and let's get things moving back in the right direction. The good news is that this pickup in volatility that we've seen in the last week presents some absolutely wonderful opportunities, and we'll have a look at some of those now. So let's take a look at first of all the ASX 200. So panning back, we're still 2,000 points below our all-time highs. So a long way short of where they have been. Now you can see that the Australian index had also got probably a little bit ahead of itself as well, and the index has pulled back very sharply in the last 2 days. Now, there's a couple of retracement levels that I'm looking at. The first one is around 4,900, which is only another 60, 70 points below where we finished the week. I think it's more likely that we'll head down to this level here between 4760 and 4800. That would also correspond with tagging the 150-day moving average as well. So here we've got the shorter time frame retracement structure, and over here we've got the larger time frame retracement structure. These two line up somewhere in that area between 4760 and 4800. So I think that's the likely area that we'll see the index head to. Now, looking at the two major components of that is the materials index. So clearly hasn't performed at all well. In fact, it's really been in a big sideways band now for quite some time, but looking a little bit more positive. And certainly the materials index has outperformed the rest of the market substantially over the last few weeks. Now let's look at how finance. Now our finance index had just got way ahead of itself. Look how far above the 150-day moving average that the banking index had got to. It just had to come back at some point in time. Now, as you can see, very, very sharp fall on the week. And what I'm unclear of, or unclear on at this point in time, is will this play out as just a straight correction down to a level and then bounce back up again? Or, that's scenario one, or will we get a bit of a bounce and then get an ABC pattern playing out to the downside like this? I don't know the answer to that. I suspect we'll see the latter, but I'll just wait and see. I'm not going to form a firm opinion. I'll just let the market show me the way. But either way, it's setting up great trading and investing opportunities because there's been an awful lot of stocks that have just got too expensive. Let's have a look at a couple of examples of really good companies, but they just got ridiculously ahead of themselves. This is a company called the REA Group, and look, they're a good business and they've got a lot of potential upside over time, but they were just priced to a ridiculous level, and technically you can see how far the price got ahead of the moving average. At some point that had to come back. So what this is now doing, of course, is it's setting up some wonderful opportunities. Now I don't know where that entry opportunity will be at this point in time, but I know what it looks like, and that's the key thing. I'm just observing and responding to what the market is providing. Let's have a look at something in the telco sector. This is iiNet. Again, the same pattern. It had a fantastic run, and there are certainly good conditions for telcos going forward, but the price needed to come back, and I'm looking for another entry opportunity into this one. Now, I don't know where that point will be, where it's high probability and relatively low risk, but I sure do know what it looks like. And so we'll just sit and wait. At some stage over the next week or possibly 4 weeks, it'll present a wonderful buying opportunity for either a trade or as an investment. Now, gold ended up gaining $31 on the week. It was a pretty solid week for gold. Short-term direction, unclear in my view. We'll have a look at the gold chart in just a minute. Copper holding steady around $3.30. Oil slipped a little bit to 94, and there's the copper chart. So let's just look at the gold chart now. So this is gold on a daily basis. You can see it really hasn't done very much over the last 5 or 6 periods, and if we look at this on a weekly, you can see it's really still in downtrend. We've got potential support levels at 1302 and about 1156. So lower prices in gold are still possible. Now, I keep an eye on the GDX index, which is the gold miners index in the US, and you can see it's really looking like it's forming a base to me now. It could break another leg to the downside, but it is starting to look a little bit more like a base is forming now. And the key chart that I keep looking at is this division between, it's the gold miners index divided by the price of gold, and I'm looking for that to turn up as a signal that this short-term bear market in gold, or correction if you like, in an ongoing bull market has finished. And you can see there is still no change. We've got no turning up yet of that spread. So we just continue to wait some more. But there certainly are a few preliminary signs in some of the Australian gold miners that are looking a little bit better. Now, just to finish off, just from a strategy point of view, I put out a recommendation to members to move to cautionary mode. That was obviously quite warranted. That was done in advance of the decline on Thursday and Friday. It may take a few weeks for this to play out, but there's going to be opportunities galore. There's already some good opportunities set up, but we may get an even better entry price yet. So for anyone that's not a member and you really want to get amongst some terrific trading opportunities, then you might want to get in touch with me in the next week or so, because this is one of probably only 1 or 2 or 3 opportunities this year that you're going to have to really get a good bite at some good profit making opportunities. They don't come along every week or every month. You only get a couple a year, and this is one of them setting up right now. Now, I wrote this last week. I've left it unchanged because the situation is still the same. The sentiment for gold stocks is basically at absolute extreme levels where we were in 2008, but we've still got to wait for the turn. So that's where we're at. A really important week. I think the next few weeks will be pretty exciting, and plenty of opportunities. So that's it for this week. Cheers.